watching Let's Chat.
This morning, we are checking in with our friends from Guardian Investments in Accounting, and we are talking about market volatility. Mr. Tyde, thanks for joining us.
Hey, thank you.
All right, volatility, a word we hear.
Yes.
Maybe we don't always know what it means, but we know it means something bad.
That's right. It's not necessarily bad. We can take advantage of volatility, but it is something that we see a lot in the market today. It's kind of a hot topic.
What are our trends right now?
So everybody is talking about the next big correction, and nobody really knows when that's going to be, but we can be certain that right now we're seeing a lot of volatility in the market.
Now, this volatility, this isn't one of your questions, so I'm going to
Okay.
surprise you. I'm sorry.
Sure.
How do we get this volatility? Is it coming from, changes in government? Is it coming from changes in consumer spending? Or a little bit of both?
It's probably a little bit of everything. A lot of it seems to be news-driven these days. If we have certain people tweeting,
Right.
that can cause more volatility in the market. And then, any kind of tariffs or anything else that we're seeing, can cause a spike or a decline in the market.
So talk about, how do we manage risk when it comes to the changes in the marketplace?
So there's a couple different ways that people do that. People will go to cash, banks, CDs, things like that. A great way that we look at managing volatility is to go to a volatility controlled index.
Okay, and what is that?
So
I have no idea what that is. You got to educate me here.
Yeah, it's no problem. A volatility controlled index is an index that has a couple different asset classes. So it's going to have something that's less risky, like cash, and then it's going to have more of a risk-based side, which is going to be stocks. And depending on how volatile the market is, it'll switch to the cash side in a highly volatile market, or when it's more stable and we can see solid growth, we're going towards stocks more.
So it sounds like there's a strategy with using these products and kind of navigating. Is that what you do for us? Do you help us develop that strategy?
Yeah, so we can
we're
look
not
at
left alone just guessing.
For sure, yeah. We can look at somebody's portfolio, and a strategy might be to move more towards a bond market or CDs or even cash, but we like to use a volatility controlled index for that, because you can still see some solid growth in that index instead of seeing lesser gains that you'd see in like a cash asset class.
So there's different products for different times, it sounds like.
That's right. So a lot of what we're doing right now with the risk of a recession coming is looking at a fixed index annuity that uses a volatility controlled index for interest gains. So think of it like as a safe harbor to weather a storm. As soon as we see that recession happen, using a shorter term, like a 5-year term, which is available, can allow you to still see solid growth when we see a positive market, but protect you from the recession if it were to happen.
So if we haven't done any planning, or we don't have any protections in place already, is it too late, or is now the time to start?
Now's a great time, because we really don't know when that big recession is going to happen. And if we can get into something, maybe take advantage of some of the positive growth we've seen in the last few years of the market, lock in those gains, and then weather the storm that's on the horizon, it's a great strategy for keeping what you've got.
All right, Tyde, how do we need to get started with you if we're ready to hunker down?
All right, so you can go on our website. It's guardianinvcpa.com, or call us at 423-892-4693.
All right, Tyde, thanks for joining us. It's always a pleasure. You always educate me and hopefully our viewers as well. I know we're going to be talking with your team at Guardian Investments again here soon.
All right, thank you.